Welcome, everyone. This is a TradeStation webinar. We title it Options Replay. It's a great way for us to take a look at the markets, see what's happening, and see what type of strategies traders are looking into. I know that Brandon is a trader and he looks at the markets constantly, so it's great to get his feedback and his insights as to what he's looking at, what could be working, what may not work, and the reasons, why something's working and something's not working. So it's great to have him. So it's a privilege to have him with us. With, of course, a disclosure that he's not affiliated with TradeStation, but it's always a pleasure to have him. Let me go through some of the disclosures, additional disclosures before I pass the microphone over to him. Keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, active trading is not suitable for everyone, and past historical performance is no guarantee of future results. The fact that one trade may have worked for Brandon doesn't mean that it's going to work all the time. We all need to be aware of the risks that are associated with trading online. Please go to www.tradestation.com /important-information if you need additional information on these disclosures. Okay, I'm going to stop my share. And again, this is an opportunity for you guys to join Brandon. I'm also going to be here in the background listening to what he's got to say today. And we're going to take a look at the markets and see what's going on and what's working. So Brandon, the floor is all yours. Thank you for being here.
All right. Well, thank you very much for having me again. My name is Brandon Wendell. For those of you who may not know who I am, I've been trading the markets for almost 30 years now, actually teaching and trading in the markets for almost 30 years. Oh, it's been a while. I started off as a retail broker, then moved into back office operations. So I was working as a trader in the brokerage for a little while. Then I ended up working for a private hedge fund. It was a small fund, only $50 million AUM, and traded that for a few years. Trained traders as well, and then I got into full-time trading for myself as well as education. So I'm a trader and a trading mentor. I do that full-time. And yeah, that's basically my background. I've also got a CMT designation, which means basically a master's degree in technical analysis. I took a lot of extra work and study to learn how to identify better opportunities in the markets. And thank you for being here. And actually, I don't live in Fort Lauderdale anymore. I moved north. I'm actually in Northern Virginia. So anyway, yeah, I'm not an affiliate of TradeStation. I was invited by TradeStation to be here. And yeah, I think Jesus already went through most of that stuff. I went through my background. I'm an active trader, as I mentioned. I do mostly futures, options, and currency markets. And I actually specialize quite a bit when it comes to options and index options. And well, basically, we're going to talk a little bit about those today. How to trade zero DTE options, which is something I do on a regular basis, pretty much every single day. Yeah, I did move. I moved in August of my August of this year is when I moved. Yeah. Anyway, so we're going to talk about how to use credit strategies to take advantage of day trading opportunities. Now, if you go to the website, let me see if I could find it real quick. If you go to tradestation.com and more importantly, the Options Education Center, if I come here on my browser to learn options education, you're going to see there's a lot of education there for you that's available to kind of talk about different strategies. Specifically tonight, I'm going to be discussing, where is it here? There it is, iron condors and butterflies. And there's a lesson on it as well. Utilize iron condors and butterflies and index options. And the CBOE actually came by and did a workshop on index options. I'm going to kind of reiterate some of what they talked about as well and use some of their material to show you some trades that have been taken and how to actually, more importantly, how to utilize that information, those strategies in the Option Station program, which I have open here as well. So getting back to this, we're going to talk about some of the risks and rewards and kind of evaluate what happens when we're looking at taking some of these opportunities and practical applications. So that's the most important part of options replay. I mean, you can go to the Options Education Center and learn about the strategies, but kind of this is where the rubber meets the road. I need to kind of go through this with you to show you how we actually employ these and utilize the tools, and more importantly, how to protect yourself in using those tools We've got some extra tools that are activation rules that could be used to take profits and also to um, protect with stop losses. So we're going to talk about how that works and how to maximize your opportunities using that platform. Now, going back to the workshop that I mentioned that the CBOE did a while back, one of the interesting things they did was kind of talk about the trading that was going on. And this is a white paper they published back in 2023. They haven't done their updated yet. So the only data I have is 2023 because that's all they released. But you can see that this dark blue is the share of zero DTE trading or 0 days till expiration. If you're not familiar with zero DTE, means 0 days till expiration. Every option is 0 DTE on the day of expiration, the last day you could trade it. But the SPX options, those are index options. Those are the most heavily traded options in the CBOE. And as you can see, they're exploding in popularity. They're probably more than 50%, I would imagine, at this point. So a lot of day trading is going on now. And when you look at this, these can be traded whenever you want during the day. Again, I go out to OptionStation Pro and I happen to be looking at SPXW.X. Let me zoom in real quick so you can see that right there. The symbol you want to use is $SPXW.X. And be very careful because there may be other symbols, but that's the one you want to trade if you're day trading. Most likely the S&P 500, you see it's PM settled. There are AM settled options every once in a while. You do not want to trade those. Well, maybe you do for other reasons, but typically for this day trading strategy, PM settled means they trade until 4 p.m. Eastern on the day of expiration. So we have today's, tomorrow's, and then Thursday, Friday. No, I'm sorry. Yeah. Going all the way. Today's Monday. I forgot what day it was. Tuesday, Wednesday, Thursday, Friday, and then again Monday of next week. So you got options that expire on that 4 p.m. and the settlement is the last traded price of that day. AM options, they actually stop trading in the evening, but the settlement price for winning or losing is the very first trade, the very first trade the next morning. So there's a big difference between AM and PM settled options. So that's why I like to stick with the PM settled options because they settle at the end of the day and you know whether or not you made or lost money, period. So basically, like I said, with the information that I got from the CBOE, they put this out. And again, if you go back to the workshop, as I mentioned right here, you've got the index option workshop. They talk a lot more about this. They actually have a lot of these slides in there. I borrowed it from them and I'm giving them credit, CBOE. But it's interesting because there's a lot of trading going on, and most people think, okay, we have 0 days till expiration. Remember, options have time decay. They decay in value the longer you hold on to them, and they have 0 time value at expiration. Well, that means on the day of expiration, they're going to be basically the clock is ticking really quick. So you would expect to get the majority of premium, you'd have to trade first thing in the morning. And if you take a look at the volume, this is single leg trading, which is okay. There's nothing wrong with single leg trading, but multi-leg trading, I think, is a little bit better. And the reason why, again, this is kind of in my opinion, but basically we do spreads or multi-leg trades. Well, let me show you. For instance, today, if you wanted to buy the 60/50 call, you click on that and you can see that we have, well, the market's closed now. Sorry, let's take one that's still tradable. That one expired already. So let's do an at the money option 60/50. There we go. And I've got the 60/50 call. My delta is 0.55, theta -6 because it expires tomorrow. So it's got a lot of time decay, right? And we can see my volatility exposure is also very high. Now, why would I only want to do one option? Well, I will gain more potentially if prices move in my favor, but I'm also going to be paying more. You can see it's $11.80. If I create a spread, in this case, I'll do a debit spread. So I'll buy the 60/50, sell the 60/80. Well, now what's happened is I'm combining the deltas and my delta has changed. So instead of 55, now it's only 39. That means I've reduced my profitability. As prices move up for every 1 point, instead of making 55 cents, I'm making 39 cents. Okay. But the reality of it is I'm also reducing my risk at the same time. What happens is I have -6 theta, positive 3.13 theta, and now my theta has been reduced to 2.88. Yeah, I'm decimalizing. This is actually times 100 down below. But you can see I've reduced my time exposure and time risk dramatically by doing that. Additionally, I'm also reducing my vega or volatility exposure. Instead of 1.25, now it's only going to be 0.75. So by giving up a bit of potential profit, I'm able to reduce a bit of risk. That's why people do multi-leg strategies, and often one of the big reasons. You do multi-leg strategies because when you do one option, you can only select the risk exposure that that option has. When you combine it with another option, creating a spread, what you are doing now is neutralizing and changing the characteristics of risk for your position. So, for instance, if I'm bullish, instead of buying the call, I could sell a call, or sorry, sell a put, excuse me, sell a put, and I could buy a cheaper put. And now what has happened? My delta has dropped to 13. Before I had delta negative 0.44. Okay, but remember, I'm selling that, so that's a positive 0.44. Remember, it's bullish. So positive delta profits when prices are moving upwards on the underlying. So that put would basically drop in value by 44 cents for every 1 point the option goes up, or 44 for the delta, for the full delta. Unfortunately, because I'm also buying an option, in this case, buying a put, I'm adding positive delta to my negative, and my overall delta now is 13.76. So I'm bullish because it's still positive delta, but it's a lot lower. So I won't profit as quickly. The time and the, I'm sorry, not the time, the intrinsic value won't decay as much, but I'm also reducing my costs and reducing risks in other areas like time decay and volatility. So my time decay exposure goes from 40 down to 20, which again, in selling, I may not want that. I want it to actually decay faster, but I'm reducing risks from directional. I'm reducing risk based on volatility. So I have to take away some of my profitability on time. You can't have it all. I wish you could, right? But basically, what happens with options is if you want to control your risk a little bit more precise, you can create a spread, which is simply creating an offset leg. It's called the offset because you are offsetting the Greeks on your anchor leg, which is the first option that you choose. So that's the reason why I do these types of spreads. And you can see with vertical spreads, there's quite a few of them still being traded. You take a look at the volume here on the SPX. Again, this is 2023. And the CBOE data, and you can see single legs, net sold. You can see sell to open 11,000. There weren't as many sells as there were buys. A lot of people bought single legs, either buy a call or buy a put, expecting the prices to move by the end of the day. The problem with this buy to open is if you don't sell to close, well, these are cash settled. So it's not like you're going to have an assignment and have to worry about getting delivery of a stock. It'll be cash settled. So I imagine that's why there aren't as many sell to close as there were buy to open in the morning. But focusing a little bit more on these vertical spreads, again, we can reduce our risk or control it and shift the risk a little bit differently from time to volatility or from direction to volatility in time. And what you'll notice is there's actually something interesting. If you look at it a little bit closer, most people are thinking, okay, we want to sell to open to collect as much premium as possible. That would be selling first part of the day, right? 9:30, 10 o'clock before the time goes by and you erode in value. But take a look at what happens right here in the afternoon. Right around 2:30, 3 o'clock, there's actually a jump in volume again of sellers. And I've been doing this particular strategy for, I want to say 9 years or so, maybe 10 years. Basically, I don't, there's a trade-off. I'm not saying one is necessarily better than the other. You've got to figure out what you like most. But if you end up taking trades first thing in the morning, you have the entire day of risk. Remember, We're trying to collect some premium by doing a credit vertical spread, either an iron condor, a bull put spread, or a bear call spread. But you have risk of prices moving against you throughout the day. If you enter later in the day, as these people did, now you have limited your risk to maybe 2.5 hours or less. Will you collect as much money? Of course not. You cannot collect as much premium in the afternoon as you can in the morning. And I have examples of this as well. Actually gone through at different times of the day and did pictures. You could use this strategy of multiple securities. I prefer just to focus on the SPX one and done type thing. I don't want to spread myself too thin with my attention as well as my physical actions. So I really just focus on the SPX, but it can be done on others. I don't like doing these types of strategies on the SPY or QQQ. Now, the ETFs may have higher premiums, but they're not European style options. Okay. Speaking of premium, this is talking about 0 DTE premium per contract, again from the CBOE. Notice high premiums in the morning, 482, 510, 495. But this is where it gets interesting. Right around 230, look at the jump again. There's another jump. So even though if you were to get in at 10 a.m., for instance, versus 1, there's a big difference in price, but or even worse, 2 o'clock. But going back to 2:30, the premiums actually go back up before the end of the day. So you're not losing nearly as much potential premium, but you are dumping off a lot of time risk. Okay. Now, I was talking about the option opportunities. Let me go forward here a moment and just show you. This is the S&P 500. This was from the 6th. So Friday of last week, 9:32 a.m., right after the bell rang. I went out and I took a picture of the at the money options on the SPX. And I want to bring up that comment. Somebody said, you only use this on the SPX. I like the SPX because they are cash settled options and they are European style options. If you're newer to trading, European style options cannot be exercised early. They can only be exercised and assigned at expiration. Now, the premiums will reflect that. I was saying before, if you were to go back to TradeStation here and go to SPY and take a look at the premiums might be a bit higher at the money right now. No, didn't switch over. There we go. So at the money right now, 605. There we are. And this is on the 9 days. Now we want to compare apples to apples. There we go. And actually, let's get less strikes for now. There we go. So we're looking at 605 for tomorrow's expiration at the money right now, 156 and 211. When we were looking at the SPXW.X. I didn't click it correctly. When you go back at the money options, you may be able to maybe squeeze a little more out of this because there's more risk. There's early assignment risk. Although, the premiums are much higher. Again, I kind of like these, but the strikes are going to be different as well. There's a bunch of differences, but the main one is these are, again, I want to do the same day. There we go. Yeah, you can see there's a bigger premium here for the same day at the money, but it's European style. So I do not have to worry about early assignment on those options. And they're cash settled. So the other thing is, if for some reason I ended up accidentally trading the wrong option, trading a 3-day instead of 0 DTE, I wouldn't be stuck with stock if it were exercised or assigned, or even if it goes in the money at the end, it's going to be cash settled. So as I mentioned, you can do that with index options. Most of them are European style and cash settled, and you can check with the exchange to see which ones are or are not. But here's what I wanted to kind of show you is you've got to decide for yourself. Do you want to get more premium at the risk of having more time for prices to move for you or against you? Or are you willing to accept smaller amounts of risk and smaller premium by getting in later in the day? And that's something that you have to answer based on your own personal risk tolerances and kind of viewing the markets as they are. Taking a look again, going back to the CBOE information, I mentioned that For the most part, the premiums do die off during the day, and that's because time is eroding the value of the options. There is typically a little bit of a spike, though, around 2:30 in the afternoon, where the premiums tend to go up. Volatility can as well. And they did a study as well. This again is from the CBOE and their information. You can find it on their website. They have a white paper that they put out about all this. When there's a normal day with no material news, this is what happens with the premiums throughout the day. They fade a little bit, but notice what happens right around 2:30. That's where the drop off occurs. Obviously, when there's a FOMC meeting going on, after the Fed releases their announcement, they do the press conference, all the volatility drops off because everybody knows whether it's going to be raising or lowering of rates. So the premiums drop off. But there isn't much of a drop off up until that point. So what I'm trying to say is it may be advantageous if you are more risk averse to accept a lower amount of premium for the fact that you do not have to enter as early into those markets. So kind of taking a look, like I said, post-mortem, I was looking on Friday, and this is kind of what I looked at on my chart, where I had a little bit of supply and a little bit of demand on a 15-minute and a 5-minute chart. And I was basically trying to identify, well, prices were pretty much stuck sideways, and it was not likely to move out of a certain range. So this was at the money, 9:30 in the morning, as you can see on the 6th. I took that photo of the market and the option chain. And if I was looking to do strategy here, basically, let me go to, oops, wrong page. Oh, no, it's the right page, wrong. There we go. Here's the SPX. Again, going back to the 6th, I can recreate it on this chart. I should have done this already, sorry, but just using the TradeStation charts. Again, we had overhead supply, and we had a 15-minute. I'm on the 5 here, so let me go back to the 15-minute. But there's a 15-minute area of demand down below. And let me do this. There we go. This was my demand. And my supply was actually formed throughout the day. Wasn't there first thing in the morning necessarily, which is another thing I'll bring up in trying to decide about these types of trades. So we're talking about this day right here, Friday, not today. I'll get to today's as well. But on Friday, basically, I identified where prices were not likely to go during that trading day based on imbalances between buying and selling pressure. Okay, I don't use traditional support and resistance. I use what's called supply and demand. Basically, I'm looking for order imbalance. These big moves in the markets to the upside or the downside, I don't really have an example too much, I guess a little bit right there. Those are due to order imbalances. Prices jump like this because there was a lot of buying pressure, but nobody was willing to sell. Okay. So, and if in this case, there's a lot of people willing to sell, but nobody was willing to buy. If you want to sell and nobody's buying, you got to lower your price to attract buyers. Conversely, if you want to buy with nobody selling, you've got to raise your bids to attract sellers. So the biggest imbalances will have big gaps or big price movements and point them out. Another thing that's kind of interesting, I mentioned my background when I worked as a hedge fund trader and even working for the institutions, trading for them through the brokerages that I worked for, we had to do what's called working the order. You would get a large order to buy or sell a security. You could not execute it all at once. You would have to break it up into smaller pieces and get those orders filled without trying to move the market too much. Because if you move the market, obviously, if you were trying to buy at 60.75, let's see. Oh, I was going to change the font. Window, I guess where it is. Let's try that. There we can see better now. Anyway, if I was trying to buy here at about 60.75, if I buy too quickly and all the sellers disappear and I scare them off because of my big demand, I'm going to have to pay much higher prices. So you don't do that. You break up your order into small pieces, try to get as much filled as you can without moving the market. When the markets move away because of the imbalance, you wait until they return. So supply and demand is simply me trying to wait for prices to return to the origin of an imbalance and piggyback on those leftover institutional orders that I know are likely to be there. Now, they're not always there, So that's why I use stop losses. So moving into this, again, if I identified where prices are not likely going to go, I could sell options outside of those areas. So in this case, I looked at doing a bull put spread, and actually I picked a level that was a little bit higher. Okay. And yeah, this is how I trade every single day for the most part when it comes to trading 0 DTE for the SPX. So you can see that 60 70, 60 75, the bull put spread would be selling the 60 75, buying the 60 70. That's at that point was $1 for the natural spread. Natural meaning I sell the bid, buy the ask. Okay, you can sometimes shave and get better pricing. We're just going to go with worst case scenario. Okay. Excuse me, I'm getting over a cold. The bear call spread at 6100, 6105 was $1.30. So altogether, if you did an iron condor expecting prices to stay within those two levels, you'd be looking at $2.30. And it's very easy to place that order. There's a couple different ways of doing that when it comes to OptionStation Pro. Easiest way that I like is building it yourself. So for instance, as example, I don't know if it'll let me pick today's, but I'll try it. Actually, I might be able to do tomorrow's, but it doesn't matter. If I were to do today's, just to show you step by step, I bring up the option chain. I could change this from spread single to iron condor. That will automatically populate, and you can see there are $5 spreads or 5-point spreads between each of the strikes. You can change that with the filter here. You can see spread width. I can add more. Now it's every 10. Okay. However, then I'm gonna have to go in and possibly change it because I may not want a nice even number between each leg. So instead, what I prefer to do with OptionStation Pro is to keep it as single for the spread and just build it manually. So for instance, today, if I was looking at building, let's say 6045, I hold the control key down on my keyboard, click the bid for selling, the ask for buying, while I'm holding control, and then do the same thing for the bear call spread. Click the bid for selling, ask for buying, and there it is. And notice what happens. It recognizes it as an iron condor. If I want to do some analysis before placing the order, I just click on analyze. If I'm ready to place the order, I click place order. And obviously it's not going to place it because this one's already expired. But that's how simple it is. And it shows you where you would profit or where you would lose based on current pricing. It's a little bit off again because everything's closed. So let me close this out again. There we go. And again, going back, this was $2.30, 2 minutes after the market opened. Now, I'll collect the most amount of premium by doing that, $2.30 or $230. What is my risk? Okay, remember, we always need to know what our risk is when we're getting into any position, rewards and risks. We need to know those things. It's important. So basically, no, I don't have a calculator open. There we go, calculator. Got everything else open, it seems. Anyway, the risk in the iron condor is basically the same risk as it is for the spreads. The difference between the strike prices. And as you see, I'm using 5 points for the strike risk. Why am I using 5? It's personal preference. You could go wider. You could use 10. I could have sold the 75s and bought the 65s. But what happens is your risk is the difference in strikes, in this case, 5 points or $5 minus the premium you collect. So in this case, my risk is $2.70. My reward is only $2.30. Your reward and risk will always be flipped when it comes to what we're taught to do. Most of us are taught as traders that we should risk less than what we potentially will gain in the trade. Well, here it's completely reversed. When you're doing these credit spreads, you will almost always have more risk than you will have reward. The reason why it's okay in this situation is because the probabilities are higher. Okay. A lot of people like to use the deltas as a probability analysis. And if you take a look, let's see, let me go to the one that's not expired yet, tomorrow's. And I don't have zones, so I'm not suggesting this is a trade. Okay, I haven't done analysis yet, but let's just say hypothetically, I'll sell the 40s and buy the 35s, sell the 70, buy the 75s. You can see that I have $2.30 credit and my risk is 270. Actually, if I do it correctly, I should do the natural, and you can see 190 profit, 310 for the loss. But my probability is high because this will profit if prices go slightly up, slightly down, but don't go below 60/40, or go absolutely nowhere from where they are right now. So in addition, differently from the credit spread, debit spreads, with debit spreads, you need prices to move far enough and fast enough in time for you to make a profit. You have to overcome the premium you paid. With credit spreads, you don't need prices to move at all. And as a matter of fact, you might even prefer them not to move whatsoever. So a net Vega, I'm not too worried about Vega, honestly. When I look at these particular trades, the main thing is you'll see my delta is extremely low, almost zero. I am delta neutral, basically, meaning I don't care if prices go up or down as long as they stay within a certain range. So do I want my net Vega to be half the anchor's Vega? Not necessarily. I honestly don't really care too much because it's such a small time frame. Typically, when it comes to volatility, volatility affects options pricing much, much more on longer term options than it does on smaller time frames. So if you were to chart out, for instance, let's go to an analyze here and make sure I only have the one trade on there. Yes, I do. So right here, we're charting theoretical P&L for now and expiration tomorrow. If you were to chart volatility, you can see that, yeah, there's a little bit of an issue with Vega and volatility right at the money, but I'm not really trading those. I'm trading for prices to stay outside, or sorry, inside a certain range. And this is going to be completely different. If we were to look at a different issue, say, for instance, I go out to March 21st for all these. I guess I don't have the right strike for that one. Come on. Basically, volatility affects longer term options much more than it does shorter term. So I don't concern myself with a measurement of Vega as much. Let me see, go back to theoretical P&L. What happened here? Oh, I messed everything up, didn't I? Oh, well. Let's start this over again. I was trying to show a comparison, but it's not happening, so don't worry about it for now. Anyway, yeah, my focus primarily when it comes to this is time decay and having the options, I'm sorry, having the underlying stay within the range I identified. Okay. And going back again, our risk is going to be the difference between strikes minus any premium collected. So I may collect a little more premium going wider. For instance, again, if I go back to trade, let's just focus on the puts for now, make it a little bit easier doing one side only. Right here, I have a 5-point spread, 35.40, and I'm collecting $1. So I have $400 of risk. If instead I were to widen the spread and buy a $10 spread, now I'll make more profit. Instead of $100, I'm making $200, but my risk has gone up quite a bit as well, 790. So my return on risk is much worse. What do we have here? 2.1 divided by 7.9, 26% return on risk versus 1.2 divided by 3.8, actually a 31% return on risk. So I'm getting a better return on risk by only doing the 5-point spread. And you can figure out kind of what your return is going to be. Sometimes it might be better going wider. Sometimes in order to get any kind of premium, you do have to go wider. On days where volatility is relatively low and prices are moving a bit sideways, you may actually have to go with a wider spread to create enough premium to make it worthwhile for taking the position. Now, let's go back to where I was here. First thing in the morning, again, 9:32 a.m., 12:06. We go a couple hours later, 11:11. Prices actually moved, obviously. Our at the money option was 60.85. We're trading 60.87. Now we're 60.90. So 60.90 moved up a little bit. If we look at the same bull put spread, it's dropped to 50 cents. and the bear call spread is $1.10. So instead of 230, now we're only collecting $1.60. Same, well, not same risk. It's still a $5 spread, but the risk has gone up and the reward has gone down. But the risk in time has been shortened by 2 hours. Is it worth it? Again, that's up to you. Do you want to have to worry about what's going on for the next 5 hours, 6.5 hours, or 2 hours? Again, going further, 12:26 p.m., same day, and pretty much the money options. We really didn't move much on Friday, did we? The bull put spread actually went from 50 cents to 70 cents because prices moved down a little bit. So that went further in the money. The bear call spread went from 110 to only 35 cents. It melted away. So now we're only 105. So we went from 260 down to 160 down to 105. So obviously the amount of premium and profit is reducing, but now we only have 3.5 hours left until the close. So our reward has gone down, but our risk in time is going down as well. And when I did put on the position, which I normally do right around 2 p.m., you can see this is at 2:08 p.m. on the 6th. I was looking at putting in this iron condor at roughly 35 natural. I got about 40 cents on that day and simply put in 70, 75 and 6,100, 6,105, only 2 hours worth of risk in the markets. But the bull put spread was at 70. The bear call spread was still 35. So it only collected the 35-cent total. Actually, that's not correct. It's not 70 cents there. I don't know where I came up with that. 65.40. I forgot to correct that. Anyway, you can see the iron condor altogether was only 35 cents using the natural. But the amount of risk went down. Is it worth it to wait? You might say no. If you had gone in first thing in the morning, again, you would have collected 230. Wasn't 260, sorry, 230 versus only 35 cents. But you have all day long for that risk and prices to move outside your range. Here's one of the interesting things. When you take a look at the chart that day, this is what it looked like in the morning. And I use things like Fibonacci extensions to get an idea of where I'm going to be placing these trades. I do not place my short strikes one standard deviation. No, I actually I do use standard deviation, yes, but I'm looking more towards 1.5 to 2 if possible, rather than just one. And I really focus more on supply and demand. And the reason why I use supply and demand is it works for me. As an example, where did I put it here? Oh, I got too many things open. Sorry. Oh, there it was. Basically, looking at this is a tracking of what I did for the month of November. And basically, these are the actual trade ideas that I had for each day of trading for the month. And there are days where I had no trades. I had technical issues. Sometimes there's no premium collectible. But by doing this, and this is not going to happen every single month. I happen to have a really good month. But here's the main thing that I look at. The average entry time was 2:12 p.m. The close, obviously, is at 4 o'clock. So my average time in the trade is 1 hour, 47 minutes. Am I hitting home runs? No. Am I getting consistent singles? Yes. The wins, 35, 35, 40. I think the biggest one was on this day. I think there might have been a Fed day. It was $1.85, 185. But it's consistency that is the key. And as far as now, there's no ratio as far as supply and demand. What I do is I use my tools to identify these opportunities in the markets based on patterns, knowing how institutions trade and the patterns that they leave. So basically, again, you have to decide this in the morning. This is why I waited a little bit longer too. In the morning, this is what the chart looked like. I knew where the demand zone was, but I didn't know where my overhead supply was. I had some projections. These are Fibonacci projections, so I had ideas of where turning points might be. Now, that was, by the way, 9:32 when I took the first picture. At 11:11, we still hadn't quite formed the supply zone for the day. So we were turning at a Fibonacci extension, both from this time frame, and actually there was also a higher time frame you can see that I used as well. So I just used not traditional, but I used technical analysis to simply identify where the prices are not likely to go first. And then I identify which options I'd like to choose outside that range. And the main thing is you got to have some sort of a rule-based strategy to do this. You can see there the supply was formed. So by 12:12, or no, sorry, it's 12:26 p.m. That's where it could potentially have identified both the supply and the demand and put in the position rather than waiting until 2 p.m. You can see it got a little scary there as we came close, but supply worked and held prices, and we ended up going sideways for the day. So it's a personal preference for you to decide when do you wish to enter, when do you not wish to enter, you know, and basically looking at which chart. I would basically, for intraday trading, I use 60 minutes and less. So I look at multiple time frames. I'll look at 60-minute and look to see where's our certain zones. Then I'll drop down and look at 30 minutes. And I also use a couple other little tools as well. But the main thing I wanted to focus on here, let's say we were doing this for today, and which I did actually, of course. Looking at today, 60-minute, I still have that same area of demand right here. Again, you see if I zoom in a little more, that big area of bullish pressure right here. And I think, oh, I'm in a different account right now. Anyway, first thing in the morning, identifying the trend and what's likely to happen for the day. And we can see we actually have a 60-minute area of demand right here where there's that imbalance and lots of buying pressure. So we're not likely to go below 60-40 or 60-45, excuse me. As far as overhead supply, again, I can use certain tools like Fibonacci extensions, perhaps, to help identify impulses and corrections where we may not be able to go above. And right here, we have this impulse up. Actually, it stalls out here. Correction. And bring that back. There we go. I don't know if that was the actual one that I used, though. Okay. And you can see we actually stalled out at 38% extension on this one. And then I went to different time frames because I'll look at the 60, I'll look at the 30, and the same thing, looking to see impulses and corrections. Where might we be topping out for the day? And this is all done before, well, I really don't do it until about 1 o'clock in the afternoon because I end up placing the trades around 2 o'clock. But if you wanted to collect more premium, if you felt comfortable, especially this morning, as the market was dropping down, if you knew that this demand zone, which was on the 60-minute time frame, was likely to hold, you could have collected a lot more premium selling the 60-45, 60-40 when the prices were down there rather than around 2 o'clock in the afternoon. I did it right here. We were a little bit higher up in price and not nearly as much premium, plus not as much time left. But here's the other thing that's really neat with TradeStation. Again, to place these types of trades is very, very simple. Once you've identified the levels that you want, okay, where you expect prices not to go beyond, I simply use a control key on my option chain in order to place the trades. So let's say we were looking at the demand today. Actually, let me go back for my overhead. So we've got the demand identified, obviously 60-45. And what else do we have here? I don't really have any overhead supply that hasn't been tested. Let's go down to the 15-minute. And again, if I did this at about 2 p.m., it's a different story. Earlier in the day, this would have been the supply zone I'd be focusing on. Closest one. This right here is an imbalance where prices dropped dramatically because we had a lack of buyers and lots of selling pressure. Get rid of this. Here we are. So we have 60-85 and 60-45. Later in the day, I might have identified this as well. I'll clone this. New parallel. There we go. Oh, it didn't go. What happened? New parallel. There it is. And could have also done 60-75. So obviously the premiums would have been different at different times, but let's say we did this earlier in the day, I would have identified again 60-45, 60-85, and you place the trade. 60-45, sell, buy the $5 spread. 60-85, sell, again, holding control down when I click on these, and there's my iron condor. Once I place the trade, let's say we do the natural spread, that's the easiest one to put in. And right now I'll just put this as GTC. So let me place that order. And that order has been placed. Once the order has been filled, okay, you got to wait for it to fill. Once the order has been filled, it'll be in my manage area. And you can see I've got other positions already there. Okay. But once the order has been filled, I could go in, right click on it, and exit. Basically, it would look like this. If I go into here, we have vertical spread, I would just go close this position. If I click on close this position, it brings up the order ticket for the exit of that position. Okay. Now, I'm not going to do that one in particular because I want to exit this one, which I didn't get in, obviously. But had we gotten into that trade, I want to make sure that I'm protected. Okay. And I can do this in a couple different ways. One, I can exit if I have a certain amount of profit or a certain amount of loss. Another great question that just came in, why don't I leg in? Because I'm lazy. Less work. If I just put it all in at once, I can kind of set and forget, really, once I put in the stops. But if I wanted to make more profits, yes, you could do that. You could leg in. I trade to live. I don't live to trade. So, I kind of like to enjoy my life. I got a lot of things going on. So the less work I have to do on this and still consider and still be profitable, the better off I usually am. Again, another decision you want to make. If you're willing to put in a little more time, you could get into the bull put spread when it's more advantageous, when prices are closer to the demand zone, enter the bear call spread when they're closer to supply, you'll collect more premium. But if you don't want to do all that, again, once I'm in the position, however you get in, either legging in or getting in all together at once, what you want to do is make sure you're protected. And we do that by simply right clicking on the position. Now I'm doing it on the order and creating the opposite order. And this is my order to exit. Okay. Now, if my zones do not hold, I want out. I'm not going to stay in and take maximum loss because I don't have to. There's actually another way of doing this. This way, you're not guaranteed to get a smaller loss. You might end up getting closer to maximum loss, but you're still going to be getting out before you hit maximum loss. Okay. Remember, when I put in this position initially, close this out for a moment, or when I was looking to put in the position initially, go back over to options, it was 45. Come on, 45.40 and 75.80. And remember, my maximum reward is 2 or 200, and my maximum loss is 300, right? That is if the prices go all the way beyond either the put that I bought or the call that I bought. Obviously, prices can't go both ways. It's if it goes beyond one or the other, the maximum I could lose on this position is $300. The difference between the two strikes minus the premium collected, right? But you don't have to lose that much. Often, what I will do is not allow myself to lose more than twice what I was willing to gain or going to gain in the trade. Now, this one's a little different because I'm gaining 200. Often, I'm only expected to gain a collection of 35 to 45, sometimes 50 cents, right? So $35 up to $50. So if that's the case, I do not want to lose 300. I only want to lose 100 if I took in 50 cents. That means I need to close out my position when the premiums are 3 times what I collected. Okay, let me put that again. So if I did this at, whoops, 50 cents, right? Max profit 50 cents, max loss 450. I wish to exit if it would cost $150 to close out the spread because I collected 50, that would be a $100 loss altogether. What I could do is when I analyze that spread, I can use my price slices and identify based on, well, it's 0 DTE, so it's the same day, but I could basically move those strikes around or slices around to figure out, okay, what would be the price level where I would lose? And obviously it's skewed right now because I have the wrong pricing for this. No, this is the newest one. It's easier when the markets are open than it is when they're closed right now. But in this case, let's say, let me widen the spread so I can show you better. If I can. Nope, this still won't let me do it. Oh well. Because I'm collecting too much profit or premium right now. But basically, if I wanted to make sure I'm out, I need to figure out what price under the analysis page by moving the slices around, what price would cause me to lose $150. And then what I do is, remember, to exit, I set up, you go back over to the position. It was actually just an order, create the opposite order. So once you got into the position, you would actually go to manage your positions, click on the position you got into, and you would right click and you could do close this position. It'll bring up the order ticket to close out the position. Now, here's the cool thing. If I just change it to a market order, it's kind of like a stop loss I'm going to put in. I'm then going to go to activation rule. And under activation rule, I could say, when do I want to get out? Well, I want to get out at whatever price I identified using the slices would cause me to lose twice what I was collecting. So the steps for this analysis would be to analyze the actual position, figure out on the theoretical P&L, where would I be losing twice my potential gains? And I would adjust this until that happens. So, let's say right here, 150 roughly. There we go, 6077. Let's say that's the price on the upside and the price on the downside. And it's not going to be exact. Okay, these are approximations, unfortunately. That's it. I would just do that and see, okay, at expiration or close to it, what would be the price level where I would lose approximately twice what I'm collecting in the premium, or three times, excuse me, three times. That way it'd be twice automatically. And that is 6077 on the upside and 6043 on the downside. Then I create that the exit order. On the activation rule, I click on the ellipse button right here and say, listen, I want this exit if SPXW.X, I'll do it twice, if it goes greater than 6077, or make sure you put the or in there, because if it's and, it can't be up and down at the same time, or if we go below 6043. I will not be guaranteed to lose that exact amount. It could be more, it could be less, but based on the price slices, I'm approximating where I would have a loss that's no more than basically twice what I was going to gain in the trade. So my reward risk ratio is 1-2, which is better than what it would have been had I not done this. And I hit OK. Now the activation rule is set. I've got the order to close. I place order. And I got to do the GCC, all that stuff right now. But again, I would do this during the day, and that order basically would just be a day order, and I would exit if prices hit that level, and I would lose approximately twice what I was standing to gain in the trade, or if it went down, I would do the same thing. And by the way, this is highlighted in another section in the Options Education Center. So basically what I've done in the Options Education Center is kind of demonstrate a little bit about index options, iron condors and butterflies, and right there, activation rules on options orders. So there's more details there. And of course, you can always rewatch this video as well. But basically the steps that I would do for doing the 0 DTE, it's a personal choice of whether you want to try to identify strong zones or areas first thing in the day. You will collect more premium. You have more time for the prices to go potentially against you. Or if you wait till later in the day, remember the CBOE even showed you the premiums tend to go up a little bit between 2 and 230. By entering then, you can still collect a decent amount of premium, but now you have a lot less time risk because there's only 2 hours until the expiration, and you may have more zones that have higher probabilities of actually working for you. No guarantees, but it's a possibility. Again, it's trading time and premium. Once you've identified where prices are not likely going to go, you go to your option chain and identify your trade. We close this out. Okay, go back to options. And I mean, you can do this on other time frames too, or any security really works. But anyway, let's say, yeah, I can go out a week from now. If I identify good zones a week from now on the SPX, maybe I look at a bigger time frame, 60-minute or 4 hour. We got another demand here, 6,000. I don't know what kind of premium I collect, but I could try 6,000. Yeah, there we go, 6,000. And I don't know, 6,100. And then I can place my trade right now. I have max profit. Again, natural, maybe somewhere in between. I could probably split this. I probably won't get the mid. The mid is just simply taking half between the bid and the ask. If you want to get in quickly, natural is the retail price. I usually try to get somewhere in between that. So maybe shave a little bit more off this and take a little more credit. And simulated might fill me quickly. I don't know. But anyway, once you're in the position, you go and place this order is good till cancel. There we go. So hypothetically, once I'm in the position, I would go to my Manage tab, find it, right-click on the position, and close this position. And that'll bring up my exit order. In this case, I have the order open, so I'm just going to go ahead and click on that and create the opposite order. There it is. I could just change actually to market. What I would do before I do this is identify using my price slices where I want to exit. It could be the zone. Maybe I want to give the zone the chance to work and not worry about the amount of premium. So in that case, I'm going to get out if the zone breaks maybe 6,000 and 6,100. Well, I go to my activation rule, hit the ellipse price, type in the symbol, and make sure you change this to or, because if you put and, it won't let you out. If I get greater than or less than, again, it was 6,000, maybe it was 6,015 or something, whatever my analysis told me, and 6,082. Oops, what happened here? There we go, hit OK. And now it's a market order that will automatically trigger if prices get to either my target on the top or the bottom to exit and minimize my losses. I would place that order. And I'm not going to place it right now because it's not going to work for me because the position's not open. Okay. So question, let's see. If I place a trade in the morning, do you wait for the market to settle in from the open? I don't, period. But if I were to look at trading first thing in the morning, I would wait for at least the first 15 to 30 minutes for the market to kind of settle in. Yes, because you have order flow. There's a saying in the markets that amateurs open the markets, professionals close them. And the saying is because there's a bunch of orders that need to be filled. Remember, I used to work for brokerages, so I was a trader for brokerage. We would have these orders would get flooded in the morning, first thing for the customers that we had to get filled. And there are games that are played. Sometime we'll go over that perhaps, but there's some games that are played in the morning to get those orders filled for customers. But yeah, the main thing we're looking for is some sort of consistency and being comfortable with placing the orders. And as I was saying, in order to place those orders easily with TradeStation Option Station Pro, just leg in. Once you've identified where you want to enter, you go to your option chain, hold the control key down to be able to select more than one option, and click on the bid for the sells, ask for the buys. Again, while holding control. And that just froze on me. What happened there? There it goes. Same thing here. If I do the upside, hold the control key down and click. Once you're in, you want to identify where would you lose potentially 3 times the amount of your credit collected. I do that using the price slices in the analysis tab. And then I can use the activation rule to place my stops should prices hit one of those areas. Best case scenario is simply just expires and you get to keep 100% of the premium. Worst case, it goes way beyond your stop and expires deep in the money. And unfortunately, well, you might get a 100% loss of the max loss, not 100% of the spread, but the spread minus the premium collected. Is there a way to backtest the strategy with the options? Not really on the intraday, no. unfortunately. You just have to do it in a simulated mode. As a matter of fact, if I log out real quick, I think I had today's. I did it on a different account. And I actually sold the 60/50s, which is good because if we close at 60/52.95, which means it closed out of the money. So let me see if I can log in again. And like I said, it's about building consistency. If you want to do it earlier in the day, that's completely up to you. The trade-off is you get more premium earlier in the day. The drawback is you have more risk of time and prices possibly moving. My reward risk I'm looking for is basically 2-to-1 risk to reward, because whatever my potential premium is that I'm collecting, I will try to risk no more than 2 times that. And I do that by exiting when the premium is 3 times, because I collected 1 and that's twice out. See, is this actually loaded yet? Still not loaded yet, logged in. That's weird. A little bit more about the price slices. Yes, absolutely. The price slices, if I get back to my Option Station Pro page. Sorry, this is actually freezing up on me here. And we're kind of out of time too. I will talk more about it next session though, for sure. Like I said, I want to try to make this as interactive as possible. If you guys got questions, I want to make sure you're comfortable with placing these types of trades. But yeah, we're kind of out of time too. So, but yeah, practice please with Sim, because it does take a lot of practice to be knowing what to do with everything. There it is. It's still loading my account. That's why. So anyway, I'm going to turn it back over to Jesus. We will talk more about the slices again to see how to use them. I actually talk more about that, understanding risk and analyzing risks when we get together again for the next options replay. I think that would be a great topic. And if you have any more questions, things you'd like us to talk about, let us know. Email us at TradeStation. They'll let us know. But thank you for having me here, Jesus.
Hey,
Turn it back over
it's
to you.
great having you, Brandon. And I just wanted to make a note here. I know that these type of sessions are great because you see not only TradeStation's technology, but also in action and in correlation with what's happening in the markets. So, we are close to the holiday breaks, and everybody knows that options replay happens every 2 weeks. So if we follow the schedule, you know that the next time would be Christmas week, which we're not going to be scheduling any webinars. So it's sad, but we're not going to be having another options replay until January of next year. So January 6th is the next date of options replay. I know we're all going to miss Brandon's insights, but we are approaching the holiday schedule and things are going to slow down a little. Hey, Brandon, thank you again for sharing your expertise with us. We're going to have Brandon.
I finally got it there, by the way, just to show you guys. It was the 75, 80, 50, 45s that I did today.
There we go. It finally loaded, right?
Yeah, finally loaded at the end.
Oh,
and it was a
wow.
40-cent credit and 35-cent credit. So there you go.
Tomorrow we'll have Brandon again at 11 a.m. in the morning. He's going to do part 2 of lesson 4 that we did on futures options. So if you want to join him tomorrow at 11 a.m., please do so. It's great to have him again. Okay. Hey, Brandon, great seeing you. I'll see you tomorrow then. Okay. Everyone, thank you for attending. Have a great afternoon, and I'll see you next in our next class. Goodbye, everyone.